Good morning and thank you for joining the Laybuy Group Holdings October Investor Webinar. I'm Jane Morgan, the Investor and Media Relations Manager. Today, I am joined by Laybuy's Managing Director, Gary Rohloff, and Chief Financial Officer, Katrina Kirkcalide. Today, we released the Q2 FY22 Activities Update and Appendix 4C, which Gary and Katrina will run through today. We will also be doing a Q&A session following the presentation. So to ask a question throughout the presentation, please use the Q&A function at the bottom of the screen. I will now hand you over to Gary.
Thanks very much, Jane, and a pleasure to be here with you again on this webinar, and welcome to all those who are participating. I'd just like to run you through some of our performance highlights. Very proud of what the team has been able to deliver over this last quarter. And whilst I won't read every single metric out, you can see them very well on the screen, I'm sure. I'd just like to call out some of the ones that we are particularly proud of because they deliver against what we've promised, which is growth in the UK. We can see that our UK growth is just south of 100% year on year. And despite our focus on the UK as our growth engine, we have not turned a blind eye to ANZ either. And you can see that just under 40% growth in GMV there. Our income is up 48% year on year, so we continue to grow that, and Katrina will talk more to that income through her conversation or presentation on the financials. The debt facilities Katrina will talk to, but I'd like to publicly acknowledge the effort she and her team put into getting those facilities over the line. They are fantastic for the business, give us greater flexibility, and she will allude to that further shortly. The affiliate marketing network, the app exclusives as we call them, is really helping us drive our growth in the UK, coupled with the continued success of our sales teams in the direct integrations, sees our active merchants up 86% year on year to 11,700 as at 30 September. That number is now through 12,100 as we've added more merchants since balance date. Our active customers up nearly 60% to 889. That number is now through 911,000. So we continue to add very rapidly as we grow in the UK. So we go on to the next slide, please, Katrina. This slide just demonstrates the growth we're experiencing over there. You know, our annualized GMV in that market now is £226 million. Our active customers in the UK up nearly 100%. And as you can see, our active merchants up a massive 332% year on year. So we're continuing to back up what we did last year to the year ended 31 March with 500% growth year on year in GMV, with nearly 100%, as you can see, on the GMV side, but adding more and more merchants. We've invested in our team. We have grown our team by 45%, and that growth is around CX, customer experience, that is, and growth in our sales team. We have a strong management group led by our GM UK Europe, John Gillen, who are helping us drive our growth and very successfully. We've launched our 2 digital card products, and we'll talk to that in more depth shortly. That is Tap to Pay and the app exclusives. And we have a slide further on regulation, which continues to be a focus of ours. We are not concerned about what is being proposed. We, in fact, endorse it. But obviously, we are part of the industry group that will be part of the consultation period in the UK particularly. So next slide, please, Kat. So I'll hand over to you, Katrina, and you can talk with pride on the debt facilities you were able to put in place.
Great, thanks, Gary. Good morning, everybody, or good afternoon, depending on what side of the Tasman you reside. So as Gary's already alluded to, we've had a pretty busy quarter trying to get 2 debt facilities in place to support the growth of the business globally. The first of which was the Partners for Growth facility that we entered into, which is a $30 million facility, split in 2 tranches, 15 mil at initial draw, and then a further 15 to be drawn on no later than 12 months into the facility. The interest rate averages out at about 10.5, with 11% being payable on the first tranche and 10% on the second. There is a line fee there of 1% as well. One of the big things we wanted to achieve with the Partners for Growth facility was greater flexibility. Certainly an LVR of 75% is more favourable on what we had seen historically, but also the revolving facility nature was something we looked to achieve with Partners for Growth. This allows us to pay back or draw down depending on the seasonality in the loan book and lead to a more efficient balance sheet. Kiwi Bank remains very supportive of Laybuy across the Australasian business. They have increased their facility from 20 mil to 30 mil, and the LVR has also increased from 75% to 80%, just reflective of the maturity there and the quality of the loan book. The maturity date on that one has been extended out to July 2023 as well, and has been set up as an evergreen facility. So certainly giving us some certainty in the Australasian market that Kiwi Bank's there for the long haul to support us through our growth trajectory there. As these facilities weren't closed out by 30 September, we have included the indicative available to draw numbers here on the slide of 18.7 million. Kiwi Bank, there's about an extra million we could avail ourselves to with the increase in the LVR and the 17.4 Kiwi equivalent there on the GBP facility available from the Partners for Growth facility. So yeah, it's been a pretty big quarter for myself and my team, and I'm extremely proud that we managed to get these squared away before today's release. Just in regards to some of the key operating metrics we've seen across the business, many of which Gary's commented on in the opening remarks. GMV for the quarter coming in there at 206 Kiwi, 112 of that coming from the UK alone. Annualised GMV for the quarter was 825, and we're certainly on target to deliver that 1 billion of GMV as we go into the peak retail trade over Christmas. Active customers are currently at 890,000. 566 of those are now coming from the UK, and active merchants are at 11,700. 2,900 are from the UK, and 1,269 of those were added in the quarter alone. So certainly the onboarding team has been very busy onboarding new merchants as well. Gary's already spoken a wee bit in terms of the revenue. So we have seen the revenue has not moved in the same percentage growth as GMV. That is due to the revenue stream that we have now entered into being the affiliate commission or the affiliate partnering model. The cash flows on that do flow somewhat later than our more traditional model. So we've taken a more conservative approach when it comes to the recognition of the affiliate revenue and following the probability of receipt. That means that until the underlying affiliate has been paid, we are not entitled to that cash. So therefore, we've taken a very conservative view not to over account for the revenue per se at the point of transaction, which we would do under the traditional model. As a result of that, we have seen the commission as a percentage of GMV drop a wee bit for the UK, down from 3.24 to 2.95. As already alluded to, it's a bit of a timing gap there, and that should right itself over the next quarter. NTM has slightly come off to 1.9 for the quarter, and holding 1.9 for the 12-month trailing as well. Defaults have actually slightly come off, so 2.5 for prior quarter, they're down to 2.2 for the quarter just closed. Just noting that as we do have a 31 March balance date, the 30 September quarter end numbers for Laybuy represent our half year, and therefore we are undergoing audit review in respect of all the numbers. Just looking at the key financial and operational metrics here, most of which have already been spoken to. GMV, significant increase there, 62% year on year, 93% growth out of the UK, which is exceptional and in line with our expectations. Income is up 48% year on year and certainly well positioned as we go into the Christmas quarter. NTM slightly down, as I've already spoken to, at 1.9. That's coming through from the income line and not a reflection of the quality of our loan book, seeing the bad debts actually come off and be a bit more favourable than the prior quarter. 73% of the New Zealand business continues to come from repeat customers, and we certainly see some consistency there in the UK with 62% of the GMV generated from repeat customers in the UK. Active merchants for the year, 1.2 have been added, as I've already spoken to, 586 of those coming in the UK and the balance of 683 in the ANZ market. I'm just going to hand back now to Gary, who's just going to cover off the regional performance before talking to strategy and outlook.
Thanks, Katrina. So we've been through the UK growth, and I'm not going to repeat again the percentages, just draw your attention to the fact that they are all going the right direction and very, very solidly as well. Some of those key merchants you can see down there, not surprisingly, the addition of Amazon and B&Q and eBay, ASOS and others has been significant in helping us drive our GMV. And as you can imagine, we're looking forward to seeing how we can see that further grow as we head into the peak trading periods of November and December. Similarly, if we go to ANZ, we continue to show very solid growth there, as we've described. We continue to bring on new merchants in New Zealand and Australia. We are attracting some very big brands out of the Australian market as well. We've got a few in the pipeline here that we're keen to get on boarded before the Christmas peak, both in-store and online. And our in-store tap to pay is proving very attractive for retailers, as we are one of the major players here in New Zealand, and they're looking to gain traction here. We just go to the next slide. Thanks, Kate. So from an outlook perspective, I think it's important that we just take a moment to recognise the relative infancy of buy now, pay later in terms of global penetration. If we look at the buy now, pay later spend in 2020 as a percentage of e-commerce, you can see it's all in the single digits outside of ANZ at 10%. But more importantly, it's forecast to double over the course of the next 3 years out to 2024. So given we are a dominant player in New Zealand, we are a credible number 3 in the UK market, we are very well positioned to take advantage of that growth and see our business grow accordingly. Can we just go to the next slide, please, Kat? This is quite interesting because the slide looks at the forecasts or assumptions around growth, particularly for digital wallet and where the market is seeing BNPL growth. You can see there that BNPL growth is forecast to grow by 100% out to 2024. And importantly, digital wallets taking up a large growth of 16%, where every other method of payment, credit, debit card, cash bank transfer, direct debit and prepaid cards are all in their negatives. So we're very well positioned to take advantage of this growth, given our obvious presence in buy now, pay later, but also the digital wallet presence we have through our tap to pay that we will talk to shortly. We have some stats here that nearly 20 million people in the UK have used buy now, pay later, and 52% of them are using it more than they were pre-COVID. So COVID has done, as we all know, a very good job of actually highlighting buy now, pay later, and obviously the benefits of that when people are not looking to use credit cards. If we just go back to the next slide, please. So this is the card technology I was talking about. You will be familiar with tap to pay. We are offering tap to pay in all of WH Smith stores throughout the UK. Recently added 260 stores through the fragrance shop. We have a number of the JD Sports branded stores offering tap to pay, and of course we have a number of other smaller SME market stores offering tap to pay across the UK as well. From a Laybuy card perspective, this is our app exclusive product, and this is the product that gives us the ability for our customers to shop at all these very well-known brands. So if we just go to the next slide, please, Katrina, you'll see just how easy it is for our consumers to purchase via our app exclusive product. So in this case, they're going on to the Laybuy app, they're looking to shop at Farfetch, they add that product to their cart, they select their credit or debit card at checkout, and Laybuy fills their payment details with their virtual card. So it's very simple for the consumer, and the order is processed as normal. They're charged the 1/6 of the purchase price, and it's that simple for them to use. This product means that our customers can shop at all their well-known brands using this virtual card called Laybuy. Our partnerships with the sports clubs, we are now the official and exclusive buy now, pay later provider for 4 of the 5 Super Rugby clubs in New Zealand. That, alongside our partnerships with Manchester United, Manchester City, Arsenal, and a number of other football clubs in the wings, gives us access to over 1 billion fans. That helps us raise our brand awareness, obviously, but getting access to those fans, offering them the opportunity to buy tickets and merchandise over our 6-week interest-free period really does highlight the fact that Laybuy is well positioned to take advantage of these partnerships. And just a quick regulatory update. Her Majesty's Treasury have recently published a consultation paper. We are participants in that, as you would expect, and we will be reviewing that paper. Our first glance at that does not raise any major concerns for us at all. We've been pretty well alongside most of this throughout the Woolard review and subsequent, and we will be providing our response by January 22 as required. We continue to watch the developments in Australia that could impact the industry. Obviously very familiar with the RBA's suggestion of surcharging, and we will wait with interest to see how that unfolds. And in New Zealand, alongside the other industry players, we are well engaged with the Ministry of Business, Innovation and Employment, and have had good and very positive conversation with the Minister and his officials, and we will be part of any discussion paper that comes out from the New Zealand market as well. So overall, from a regulatory perspective, sorry, Kat, we are well positioned to participate and certainly not bothered in any way, shape or form by what is being proposed right now. If we just go to the next slide, from an outlook, as Katrina has already mentioned, we are on track to achieve that $1 billion in GMV for FY22. So a significant milestone for Laybuy, one of many we've had over the last 4.5 years, but certainly a significant one for sure. We continue to accelerate that growth in the UK, and I think our numbers are evidence of that growth. And we're building our awareness more and more through partnerships, as I've alluded, through our affiliate marketing program, the app exclusive, and through participation in events like this Retail Live that we were part of just recently up in Manchester, where this stand was regarded as one of, if not the best stand at the whole event. The feedback we had was outstanding. So it's a credit to our team for what they put together and how they represented Laybuy at that event. And finally, just a little bit of an update on our most recent Laybuy Mania. As many of you will be aware, we run this event twice a year. Our last 2 Mania events were obviously April of this year and November of last. You can see the uplifts we have had over those events, 27% up in GMV over November last year, 61% of that up in the UK, and average order value up 23%. Against April, those numbers were 11, 22 and 15 respectively. I think what was really great for us was one of our largest merchants saw a 58% increase in Laybuy share of checkout over that 48-hour period. So obviously Laybuy Mania is working for our retailers, it's working for our customers, and most certainly working for Laybuy. So these events are now on our calendar, they're now on our retail customers' calendar, and more our consumers are becoming aware of this opportunity to shop and pay by Laybuy. And I think that is our last slide. So Jane, we're more than happy to take questions, and thank you all for participating today.
Wonderful. We actually have had quite a few questions come through. Let me jump into them. So webinar attendees just asked about customer reviews regarding the problems associated with the app exclusive transactions. Has this problem been resolved?
Yeah, look, we've been absolutely surprised at the uplift on the app exclusives. We had a forecast and plan for 500 orders a day in our first month. We were achieving north of 3,500. So we have ironed out the lion's share of those wrinkles. They continue to present their own unique challenges, but I can assure you our team is all over that, and we have recently increased our customer experience or customer support team to support our customers with their inquiries.
Wonderful. And Katrina, probably one for you. So 4C item 8.4 has 23.7 mil in available funding, so equating to less than 2/4 of cash burn at the current rate. The webinar attendee is asking about capital raise, or whether we're in a position to keep going.
Yeah, no worries. Thanks, Jane. So Mark, you'll see that within the contents of the 4C that was released today, we did put in some pro forma numbers. We were conscious that those debt facilities weren't closed out by 30 September, so we were unable to reference the available to draw in the prescriptive 4C format. On a pro forma basis, we do actually have cash of 42 million, therefore giving us quarters of cover of 2.5, which is obviously a bit more favourable than what was presented in the 4C. In terms of capital raise in the next quarter, there's no need to. We are expecting positive cash for the March quarter in line with last year, and just as the book comes off after the seasonal peak. Obviously, that's at the board's discretion. If it's in the best interest of all the shareholders to go out and raise capital when that time is, but for the foreseeable future, there's no immediate need to do so.
Thank you. And Gary, I'm going to hand over to you now. So in terms of competition, what are we seeing in the UK, and how competitive is it for merchants and for consumers?
Well, look, Jane, I think our results speak for themselves around competition. You know, we're up 100% year on year or thereabouts. And October, on our run rate basis, will be well north of September's number, which was a record month in itself. So, you know, competition's good, forces you to be better than you were yesterday, and we welcome and embrace competition. But as I said, we've carved out a very favourable third place position in that market. We continue to grow, and I can't point to anything else other than the growth numbers as a response to how we feel about competition.
Well, just on that, actually, on the competition. So is it right to think that the UK market will be dominated by the top 3 to 4 players only? And Laybuy obviously has a huge start in that.
Look, I think Australasia has demonstrated that there's plenty of room in a market for a plethora of players. So, and whilst that market's dominated by Afterpay and Zip, there is still space for many other players. So I think there is never a one or 2 or 3 players takes all. But what I do think is that there will be niche operators evolve in much the same way as we've seen in New Zealand, targeting different verticals with different products. Our focus is all about our market position, as you might expect, and cementing that third place and growing it and closing the gap between ourselves, ClearPay, and ultimately Klarna.
Perfect. So webinar attendees just asked, seeing your comments about focusing on UK and deferring from the US. So given the current US penetration is about 2%, how long do you think you have to make a final decision on entering the US market? And what level of penetration did the UK market have when we entered there?
Oh, look, our focus is squarely on the UK. And I think from the numbers we showed, the penetration in the UK was about 6% for 2020 of buy now, pay later and e-commerce. And that plays against 10% in ANZ for the same period. So the UK market is double the size of New Zealand and Australia combined. So we see a very big runway there. We will continue to focus on that UK market and cement our position there. I don't want us to become schizophrenic or distracted from the UK and the growth opportunity by the baubles across the Atlantic. if and when we choose to go into the US market, we will have a very firm plan that will ensure we are able to attack that with gusto and not just be an also-ran.
Perfect. Another one for you, Gary. So is the existing Laybuy team able to deal with the growth of the business, particularly in the UK?
Oh, look, we've grown the UK team to 30 and continue to grow. That's a sales, marketing, and customer support hub. We are looking at putting some other roles into that part of the business to support a more global growth plan that includes Australasia and New Zealand. I think the team certainly has the capability. We have plenty of growth options available to us from a people perspective as well, and we know where we need to do that. No question, the talent war that is going on globally plays a part in attracting people and talent to the business. But we've carved out, as I say, a very good brand that is Laybuy, and people are certainly not afraid to come and join a company that is growing at the pace we're growing.
Wonderful. Katrina, one for you. So how does your default rate compare to the competitors?
On mute, Kat.
Sorry. Yeah, very good question. As everybody knows, the buy now, pay later providers, it's really a scale game. So our default rates are higher than Afterpays, but certainly lower than Zips. By way of reference, in New Zealand, I mean, our default rate is less than 1%. So we know as the market in the UK continues to mature and we get more repeat customers coming through, we will see overall our default percentage decrease.
Wonderful. Another one for you, Katrina. So it looks like the operating cash outflow in the quarter included a large increase in the loan book due to the growth in GMV in September. So does this mean that the real operating cash outflow could be considered lower, something more like 9 to 10 mil?
Yes, that is correct. And also I would highlight in there, we had our annual insurance review as well. So that was just over $1 million in OPEX that went out for that, which is obviously a commitment for a 12-month period.
Wonderful. I think that's all, that covers it all. Thank you everybody for joining us today. If you've got any other further questions, please feel free to reach out via the contact details on the bottom of our ASX releases. But thank you for joining us, and we look forward to updating the market in the coming weeks.
Thank you, Jane. Thank you, everybody.